So let's get started. Again, thank you everyone for joining us this afternoon from your most likely at home location. I know it's a difficult time for everybody, and so thanks. We're concerned for you, and hope you're all and everybody you know is healthy and safe. We're going to do this the following way. I'm going to start and talk for about 10 minutes, and then just, on some stuff that I thought about, and then we'll open up the floor a little bit more for questions. And again, you can use the chat functionality at the bottom of the screen so that I can, see those questions and answer them, whether they be at the time you ask it or I get to it at the end of my little bit the presentation. We should be here probably till about 4:30, 4:45. Hope that's okay for everybody. And with that, we'll get started. And again, everybody is muted for the time being. I'll unmute people to ask questions as well if you didn't chat them in, okay? So here is the simple part. It is scary out there, and it's okay to be scared. And obviously, we're concerned about our health, the health of our family. We're all feeling it in some way. Some of us are cooped up with our kids learning from home. Some of us have cabin fever. Some of us are dealing with lack of social interaction. So for each of us, these feelings, they're going to ebb, they're going to flow over the course of however many weeks we're dealing with this, and hopefully weeks and not months. As far as the markets are concerned, it's, obviously watching what's happened in the last month in markets is scary. Our fears have happened in more than one department, and we all have what's called loss aversion. We all hate losses more than we like gains. That's normal, and it causes us to be particularly worried in times like these. We see the markets, they go up 10%. We don't bat an eye. We don't cheer. We don't say, great, everybody's doing a great job. They go down 5%. We all kind of get worried. And obviously in this particular time with the volatility that we're seeing, it's particularly amplified. When we talk about what's actually going on, some of the market jitteriness is not only obviously about the economic effects that we're seeing with businesses being shuttered by the government for everyone's health, but it's also due to second order effects, liquidity issues in the lending markets, how energy companies will do with drastically reduced oil prices because of what's happening in Russia and Saudi Arabia and with OPEC. Airlines as well. Of course, and also corporate debt is an issue. A lot of companies were highly levered and had borrowed to buy back stock. And as a need for cash came up, we saw everything sell off. So while rates fell initially, we saw demand for cash causing people to sell off bonds late last week. And of course, additionally, Fed action is trying to counteract some of these things. So for example, the Fed action early this morning caused futures to go up 6%. Now that didn't hold, but nonetheless, because we were expecting other things to follow behind it, but that Fed action to guarantee loans and to buy assets has been very supportive of the market. Market action last week, particularly on the equity side, was playing around the level of the bottom in December of 2018. We were testing the lows from that time frequently, and it looked like another leg down was, definitely likely, especially the way the market closed on Friday. And it looks like we may be suffering one a little bit, but it's also going to be partially on the back of whatever Congress comes up with when it comes up with it. It will help, but not necessarily end what we're in. The volatility, of course, is unprecedented. We're seeing volatility indices at levels not seen since 2008, and it'll continue until society better feels that they understand the effects on health and the economy sufficiently. For us here in New York, I think we understand it perhaps a little bit better since this has really been we have the most cases in the country here, but other places in the country haven't quite gotten to that level yet and may not get to that level for a little while. And a lot of the volatility is due to lack of knowledge, not only about the virus, but about what's going to go on in the market and the economy once we get to the other side. Now for going forward, the longer this goes on, the longer the recovery will be. The psychic damage from it, the potential reversing of new habits, and concerns about new increase in infections, assuming that we're able to reverse the trend of and get infections lower to a lower amount. There's some concern about secondary spikes going on in China or in Korea right now. I'm not sure how good those are, but those could creep in and play another role in how markets react. Now, of course, in terms of the economy, the shutdown was really, really fast, but the return to normalcy will necessarily be slower and more incremental. So the recovery is going to take some time. And of course, we're going to see some changes that come out of this. Lasting changes are not yet known on corporate behavior regarding real estate, since we're all working from home. Will they try to get rid of leases, and how will that affect things? Consumer behavior regarding online purchases. Since we can't leave our homes, we're ordering more things for delivery, using things like Amazon or Walmart or Target to deliver things directly to our house. But there are some positives in the economy. Amazon's hiring a bunch of people. CVS announced that they're going to be hiring 50,000 people. 7-Eleven is hiring. I know this is more about hourly workers, but they can shift from what they might have been doing before and get some work now while they've been laid off. Other possible lasting changes which could affect the recovery and returns include debt ratios of companies and individuals. So, again, we've seen companies take advantage of cheap debt and buy back stock. That may reverse. Individuals have been pretty good about maintaining household debt ratios as compared to where they were before the Great Recession 12 years ago. They're still in pretty good shape. But of course, there are still many people who, for example, didn't have cash to weather a storm like this. Increased understanding, which might lead to increased understanding by many people and companies about having an emergency fund for expenses and job loss. Right? This is a situation where many people who were either working hourly or working in the entertainment industry or working part-time, all of a sudden were cut off from their income because their businesses were closed. And now, what do? They're all filing for unemployment and trying to play catch up and just to maintain where they can get, where they are for the next couple of weeks. If those things happen and people become more conservative in their personal finances, it actually leads to a backwards outcome in the stock market. It makes people individually more healthy, but it also means that they're not going to be as aggressively investing. Now, hopefully over the long term that reverses, but that might mean that the stock recovery will take longer, especially if businesses are doing this and dialing back on the debt. Globally, globalization will be reconsidered, not just from China, but from others. We've seen that we've become very reliant on China for a lot of things. For example, our medicinal supplies. Obviously, some of the medical supplies were coming from China, and China was shut off for a while. And so that's led to some, perhaps, of our health issues here in the immediate term in this crisis. So what's going to happen is there might be more manufacturing coming back to this country, which of course could be good for us here, but it would lead to perhaps lower profits because you'll have more people, having to pay higher wages to local workers. These kinds of things are yet to be played out, and we don't know how much, but it could be both good and bad for stocks. And of course, now we're coming up on the emergency policies that we're dealing with, whatever the stimulus might be. The question is, will those things become permanent? So, for example, are we all of a sudden going to write in a universal basic income, for example, which is possible for the next couple of months as a part of this stimulus package? And what's that going to do for the November election? Obviously, the Fed action this morning essentially is just turning on the printing press and increasing monetary supply, which is very inflationary for the economy. How long will that be in, or are we going to try a policy like modern monetary theory for real, which is essentially just print money and print money and print money without ever having to worry about paying it back? So that is certainly some things that we have to look out for over the intermediate term and worry about for the long term coming out of this crisis. But that's not really going to, that's kind of where we are. So, and issues I have my mind on. Regardless, in terms of investing, we're still in the long term, over years and years, still thinking that this is a great opportunity. Obviously it's been very painful for most of us. We've rebalanced portfolios over the last month. We may need to rebalance them again, but we want to set up everybody for the best opportunity for success. So that's kind of what we're doing. And Stephen, I don't know if you had anything you wanted to add on this, and I'll leave it for you and open it up for questions.
Can you hear me?
Yes, I can, Steve. Go ahead.
Okay. I was just going to say, as we always say, and looking at the long term, is that you have to stay the course. What one has to realize that seems to be happening is the hedge funds and any leveraged money that's in the market is is liquidating or has already liquidated. And the first thing they're going to do is sell the most liquid assets. So that'll be their treasuries, which we've seen after the drop in the interest rates. You saw that they started to back up the sale of treasuries and commercial paper because hedge funds and anybody who's leveraged is being called on margin on these drops. In terms of even investing, not that I like to catch a falling knife, and I don't believe there's a point where you want to jump in here. One of the things that one can look at is nibbling in to the market, because somewhere down the road, we're going to say there's an opportunity the same way that 2008, 2009 presented us with opportunities to invest. So it's really a matter of standing your ground. One of the things I have done, even with my own portfolio, is look at the difference between 2018 and where we are today. Because 2019 was as unusual as this year is unusual to go down. 2019 rallied significantly, and we really gave all that back in these last few weeks. So when I look at it from 2018 or on a longer perspective, I'm not panicking that I'm losing money. I am making money. It's just not at the rate I would have liked to. You know, those are just some of the thoughts I have. I'm basically staying my course with the portfolios because I know that in the long run that they will perform. I don't know if anybody else had any comments or questions.
But please use the chat window so that if you have a question, we can ask of it, because there's some background noise from others out there if I were to unmute you.
Hi, this is Bob. Russell, I know you said you rebalanced the portfolios. I didn't get any notice that mine were rebalanced. I know mine was pretty conservative in the first place.
Let me check that, Bob. We can certainly take that offline, because I don't want to do a lot of discussing about your personal.
Yeah, that's okay. But because I know you mentioned that you would rebalance. So we could talk about this afterwards.
Yes,
As
sure.
I had you.
Yep.
I figured I'd ask, okay?
Yep.
You could, don't do it now.
Yep, offline. Absolutely.
Okay, I'm going to say goodbye.
Okay.
Good seeing you, and thank you for the updates.
You're welcome. So yes, I just got a question about beyond regular rebalancing. So we do rebalance every year. We actually tend to rebalance in February. We did do that, like I said, and have looked at it again. I don't think at this moment we've seen a need to do additional rebalancing at this time from the last couple of weeks, even from last week, but we will certainly be looking to see if that's necessary in certain portfolios. Everybody's a little bit different, perhaps, especially in the way their portfolio is. So if we were to have a move one way or the other that seemed to be sustained, then we would consider it again. So, you know, with stock markets moving 5% a day in some cases, we're not going to sit here and rebalance every day, because, you know, we're moving 5 or 6% within a day, and that could be a big problem in terms of making sure, you know, for many different reasons. If we try to, oh, we're up 5% in the morning, how do we know whether or not to rebalance? So it's really about finding some stability before we determine whether or not to rebalance again. So I just got a question about whether or not everybody's portfolio got rebalanced as per usual. Yes. So everyone's portfolio got rebalanced as per usual. We did put some parameters on that. We didn't want to like do $8 trades. So we were looking to set a minimum to the amount of dollars that we traded. But if you did put money in, and you know, and anytime money goes in or comes out, the portfolio is rebalanced. So that is also something to be aware of. So if you had an RMD or you made a contribution, the entire portfolio is rebalanced at that time. So if there aren't any other questions, we'll be happy to end it here. Obviously, you can reach out to me and or Steve directly if you have any other questions on the back end. Thank you all for your time and for tuning in. Steven?
Thanks, Russell.
Thank you. Yeah.
Okay.
Thank you very much.
All right. Be well. Have a good one.